Welcome to Share Views with the ever delightful Stefano Barbaglio, who's the Director at Siberia Services, and with Ian Williams, who's a Chartered Wealth Manager, Chairman and CEO of Charteris. How are you today, Ian?
All right, thank you. Very fine, thank you.
Right, I just wanted to talk to you about, because we don't want to get too immediate about the markets, but a bit of a wobble on the Trump reflation trade this week. Is getting into gold and silver one of the cures for this particular ailment at the moment?
Possibly. If you look at the seasonal pattern of equity markets, particularly the US and the UK markets, they tend to be very strong in the first quarter. So if you take an average seasonal pattern over many years, you'll find they nearly always go up in the first quarter. And then they tend to peak out around April usually, maybe May. Selling may go away, but statistically it's more really April. So what you're finding now is you've probably had most of the sort of good performance from the first quarter, and now they're starting to flatten out a little bit and be subject to a bit of profit taking. And where all the institutions invest their money in the first quarter, once they've allocated that money, then you need fresh buying power, and statistically it tends to run out of steam. Maybe not quite now, maybe in about a month's time or so.
And is there a seasonal pattern as far as the precious metals are concerned as well?
Yes, but it's a different one. So what you tend to find is that the demand, particularly for gold, is bunched into the final 4 months, 5 months of the year. So it kicks off with the monsoons in India. Then after the monsoon, you have the Indian wedding season, and the brides tend to be covered from head to toe in gold. And India is the second biggest buyer of gold in the world, but it's bunched, very much centred around the Indian wedding season. And then when that's over, you run into Christmas, so you've got all the jewellery demand for Christmas presents in the West. Then when that's out the way, you've got Chinese New Year, and the Chinese are the biggest buyers of gold in the world. So the three big physical individual buying of gold tends to be bunched into the last 4 or 5 months of the year. So you've got a seasonal pattern, and it tends to leave a bit of a shortage in the market, which tends to run through, and it knocks onto silver as well. So there is a seasonal pattern, but it's not the same one as the equity markets.
Let's have a look at the pattern that's on this chart that you brought in for us. What is this telling us?
Oh, well, that's our gold fund over the last year or so against the XAU Philadelphia Gold Share Index converted into sterling. The fund is the black line and the yellow line is the index. So it just gives you a clue. Again, it points to the seasonal pattern following through into the first 4 or 5 months of the year. Last year it spilled over, it went on a bit longer than it normally does, but you can see, if you look at that chart, that the sector peaked out in around July and August. And then it sort of sold off a bit between July and November, and now, as we're in March, it's sort of midway through its strongest part of the year for gold and silver seasonal performance.
If we want, Ian, if we want to look separately, gold and silver, what would you say to investors is the most attractive commodities at the moment? What's the upside as well?
Okay, well, a lot of people look at gold and silver because it's inversely correlated to equity and bond markets. So if you're going to have a balanced portfolio, it's quite a good asset to have some capital allocated to. Also, of course, if the deflation is coming to an end and inflation is going to take over, gold and silver are probably around the best inflation-proof assets you can buy. But if you're looking at gold versus silver, silver is a lot more volatile than gold. It's got a lot more upside potential than gold. So what we say to investors is, if you want exposure to precious metals and you want to get the maximum amount of money that you're going to make, if your view is correct, you're going to make a lot more money in silver than you will in gold. That's why our fund outperformed the index, you see, so much, because it's 70% exposed to silver mining companies as opposed to gold mining companies, which is where the outperformance came from.
Okay, and if we want to look at some particular company in the silver sector, which one would you recommend?
Okay, well, if you're primarily talking to UK investors who don't necessarily want to deviate too much outside the UK. Within the FTSE 100, there's one big company, biggest silver mining company in the world, called Fresnillo. Although it effectively mines for silver in Mexico, it is a UK FTSE 100 company. And then we've got another company called Polimetall, which was in the FTSE 100. It dropped out, but because the shares went down a bit, now the shares have rallied up. It's probably going to re-enter the FTSE 100 when they do the next reshuffle, and that's a silver miner as well. And that's got a big mining interest in Russia. It's effectively a Russian silver mining company. And the only other one, really, the big one in the UK is Randgold, but that's a gold company mining in Africa rather than. But so there's three big ones in the UK, two of which are silver mining companies.
In Russia, I understand that there is also a quite interesting Canadian company that has got quite a big project in Russia, that's Silver Bears. Would you like maybe to tell a little bit more about this company, which I understand your fund has got interested in?
Oh yeah, we've got an exposure to a company called Silver Bear. Now this is a Canadian mining company. Its shares are quoted in Canada. But it's got a mining project in Siberia in Russia. It's got quite a long license on the mine, about 25 years from the Russian government. It's got very cheap, it's a very good quality silver deposit. There's a lot of silver there. It's quite cheap to get out. But the company itself only has a market cap of about £40 million. It's absolutely tiny. So if you look at the amount of silver, the proven amount of silver that they've got, and then relate it back to the market price, it looks incredibly good value if you're prepared to put up with A, Russian exposure, which you'd have to put up with if you bought Polimetall, and B, the other problem is that the mine is in the middle of nowhere, so logistically it's not the easy. There's no real infrastructure around the mine, but there's definitely silver there. It's cheap to get out, and the company, we think, is worth a lot more than £40 million.
But let's say that I'm going to buy silver today, right,
Yes.
at today's price. What is the upside that I can make, and what is the time frame that I'm looking at?
Okay, you're talking about like a silver ETF. You're talking about silver or a silver mining company?
Silver mining company, let's say.
Okay, well, let's go back, say, to last year. Gold went up about 15%, silver went up about 25%. So there's a rough idea of the volatility between gold and silver. The mining shares went up, our fund went up 130%. So you get massive leverage last year of the mining companies over the actual metal. So again, if you want to maximise the upside, you're better off in the mining companies rather than the actual metal itself, because they have fixed or semi-fixed costs. So if you could imagine, say you have a theoretical company, silver mine company, that has all-in sustaining costs of $13 an ounce, say, and silver's at $14 an ounce. That company's barely making any money at all. It's barely profitable, and if the silver price dropped to $12 an ounce, it would be loss-making. So that would be reflected in the shares. Now, if the price of silver suddenly jumps up to $18, $19, and it's quite volatile and can jump there quite quickly, all of a sudden, the company's got operating profit margins of 40, 50%. So it literally moves from a company that's not making any money at all to a company that's probably got operating margins bigger than any other sector in the world. So you can see how volatile that will make the shares, you see. You get a massive reaction then in the shares. And sometimes it's even more pronounced, because you could have a higher cost producer that's actually losing money, and next thing you know, it's starting to make a lot of money. So the effect on the shares can be quite dramatic.
Is there any other company in the silver space that you would like to recommend to investors?
It depends whether they want to venture into overseas stocks or not. I mean, the biggest holding we've got in the fund is a company called MAG Silver, which again is another Canadian company. It's got a world-class silver deposit in Mexico. Most of the mines are in Mexico. But they're not the operator of the mine. Fresnillo, which is the UK company, is the operator. MAG have a 44% stake. But this is a phenomenal deposit. But because MAG is a much smaller company than Fresnillo,
There is more upside.
it's much more has a much more proportional benefit to MAG than it will do to Fresnillo. But it's a world-class silver deposit, probably the best one in the world.
Ian Williams, Chairman and CEO at Charteris, thank you very much for helping us with share views this week.
All right, thank you.